Hi, my name is Colin Lightbody, and I'm the president and founder of HR and Labor Guru, Inc. On behalf of the company, I'd like to welcome you to our on-demand webinar series. Before we get into the presentation materials, I'd like to take a few minutes to let you know a bit about our company and also give you some insight into my professional background. First, let's talk about the company. HR and Labor Guru's goals are to provide practical, value-added, human resource and labor solutions to our clients through on-demand webinars, plus training and consulting engagements. Our company specializes in a number of areas, including the following. First is bargaining preparation and strategy formulation for labor negotiations, development of negotiations costing models and bargaining tools, identification of opportunities to reduce and/or mitigate rising labor costs, healthcare cost reduction strategies, addressing high unplanned absenteeism, including FMLA in the United States, and finally, HR analytics in terms of building effective analytics teams and identifying and executing high-value projects. Next, let's talk about my professional background. I established HR and Labor Guru in 2019 after retiring from Fiat Chrysler Automobiles, or FCA, with 20 years of service. My last position held at Fiat Chrysler was Director of Labor Economics, People Analytics and Insights, and Hourly Attendance at Chrysler World Headquarters in Auburn Hills, Michigan. In terms of labor negotiations, I have over 20 years of union negotiations experience, and I've been actively involved in numerous multi-billion-dollar deals. While at Fiat Chrysler, I was actively involved in virtually every set of national negotiations in the United States with the United Auto Workers Union since 2003, every set in Canada with Unifor, formerly known as the Canadian Auto Workers Union, since 1999, and every set in Mexico with the CTM Union since 2004. My roles and responsibilities ranged from being a bargaining subcommittee chairperson to benefits accounting, labor economics, and labor strategy expert, to negotiating with presidents of the national labor unions. In 2007, I participated in the negotiation of the transfer of Chrysler's multi-billion-dollar retiree health care obligation to a United Auto Workers Union-sponsored healthcare trust. In addition, over the years, I was actively involved in facilitating several special agreements, including corporate restructuring deals pertaining to shift eliminations, plant divestitures, and plant closures. In my opinion, though, my biggest claim to fame is the fact that for many years, I provided strategic bargaining guidance and worked directly with the late FCA Chief Executive Officer, Sergio Marchionne, arguably one of the best negotiators of all time. Also, I was a member of the Mercer Labor and Employee Relations Network in the United States for over 10 years. Therefore, I had the distinct pleasure of networking, benchmarking, and sharing best practices with some of the world's top labor executives from multiple industries on topics ranging from absenteeism challenges to labor negotiation strategies. In terms of HR analytics, as head of the People Analytics and Insights team at Fiat Chrysler, I directed numerous special studies, including the following: internal labor market maps and employee turnover studies for the salaried workforce, and deep dive studies on topics such as absenteeism and hourly hiring process for the hourly workforce. In addition, I was an active member of Mercer's HR Analytics Network, known as the Internal Labor Market Network, for over 3 years in the United States. As a member of this group, I had the opportunity of networking with some of the world's top HR analytics professionals and consultants. We regularly shared stories about growing pains, the challenges, the success stories, and the lessons learned from our unique HR analytics journeys. From an educational perspective, I'm a professional accountant, both a CPA and CA, and I was employed at Deloitte & Touche for 10 years prior to joining Fiat Chrysler. I also hold a Bachelor of Commerce degree with a concentration in accounting and finance from the University of Windsor in Windsor, Ontario, and also hold a Master of Business Administration degree with a concentration in human resources and labor relations from Wayne State University in Detroit, Michigan. The first item to address is why should you attend this webinar? Rising all-in labor costs are one of the most significant challenges facing employers today. Labor cost increases are primarily attributable to two items: wage inflation and healthcare cost inflation. This webinar represents part one of a two-part series that focuses on opportunities to reduce and/or mitigate rising all-in labor costs. This module highlights two specific cost reduction opportunities: modifications to an organization's compensation structure or to its workforce composition have the potential to significantly mitigate rising labor costs over time. In fact, changes to a company's workforce composition can be one of the most union-friendly cost reduction opportunities available. This webinar illustrates numerous practical alternatives for organizations to consider in addressing rising all-in labor costs. Part 2 of the series focuses primarily on cost reduction opportunities relative to healthcare, pensions, and other employee benefit costs. The key learning objectives in this module are as follows. First, develop an in-depth understanding of the numerous financial elements that should be considered when calculating all-in labor costs. Second, understand several internal and external factors to take into consideration when contemplating modifications to compensation. Third, compare and contrast employee or union versus company preferences with respect to compensation alternatives. Fourth, recognize strategic opportunities to offer lump sums and or variable compensation versus fixed wage rate increases. Fifth, understanding of the key attributes plus the financial and non-financial metric aspects that should be considered when designing a variable compensation program. Sixth, obtain a clear understanding of how changes to a company's workforce composition can be one of the most union-friendly opportunities to significantly reduce and or mitigate rising all-in labor costs over time. And lastly, appreciate that there are several distinct alternatives to facilitate modifications to a company's workforce composition. Who will benefit from this module? Any directors or vice presidents who have direct responsibility for compensation or who are in the process of restructuring their labor cost structure. Labor relations professionals, anyone involved in the union negotiations process, including communications and finance teams that are in the process of preparing for bargaining, and controllers, regardless of whether you're union represented or not. The first major section that we're going to look at is compensation. Before we get deep into compensation, I'd like to take a look at the key components of labor costs. And when we're talking about labor costs, you'll often hear people refer to all-in labor costs. And with all-in labor costs, we're referring to everything from compensation to paid time off to benefits to legally required payments. So I'm going to take a quick look at some of the components here. So the first category is compensation. That would include elements like salaries and base wages, cost of living allowances, or COLA as it's commonly referred to, wage premiums such as overtime premiums, shift premiums, team leader premiums. Lump sums could be anything from negotiated lump sums to ratification bonuses, and variable compensation such as profit sharing, quality incentives, attendance awards, etc. The next major category is paid time off. This includes items like vacations and holidays and other paid time off such as bereavement, maternity, parental leaves, military duty, jury duty, things of that nature. The third major category is benefits, and that would include elements such as healthcare, pensions, other benefits such as short-term or long-term disability, sickness and accident, life insurance, any retiree benefits, etc. And then finally, the fourth category is legally required payments, or payments that are paid to the government, required by the government for pensions and unemployment compensation. So this would be things like FICA for Social Security and unemployment compensation payments in the United States, or Canada Pension Plan, employment insurance, or employer health tax in Canada. We're now going to turn our attention to some of the key considerations to look at when looking at compensation. First one, you should take a look at the economic environment. What are inflation rates? What have they been the last few years? What are the forecasts for the next few years? Also, are we expecting an economic downturn in the industry or in the economy? For example, these days, we've been riding a pretty good increase in the economy for the past 8 or 10 years, and it's just a matter of time before we start getting into a downturn situation. What are your competitor compensation levels? Do you have access to data? Can you look at Bureau of Labor Statistics or Statistics Canada information? Is information readily available on your competitors, etc.? Or can you hire someone to take a look at it for you? What are your attrition rates? It may be a good signal for you. So if you have high employee turnover, it may suggest that your wage rates are too low. Conversely, low employee turnover may suggest that your wage rates are either reasonable or high, so that's another good signal to look at. Are there currently any operational challenges in the company? For example, are there challenges with quality, or do you have high absenteeism? Maybe there's an opportunity to link some of those operational challenges to compensation. In many cases, quality awards and attendance awards can be more or less self-funding, provided they are properly linked to the metrics themselves. For those of you in the union environment, there are a number of things that you can look at as well. You can look at historical settlements. Take a look at the past and see if there are any patterns. Does the union, for example, ask for general wage increases in every year of the contract, but then later on settles for perhaps one wage increase with a couple of lump sum payments? Another excellent source of information is looking at recent industry settlements. What is the union settling for recently? Is it base wage increases, lump sums, some combination of those two, or what is the amount of the lump sums? What is the amount of the wage increases? Recent union settlements are another excellent source of information, especially if the union that made the settlement is the same union that you're dealing with but in a different industry. Looking back to 2011, when the Detroit 3 automakers were preparing for negotiations with the UAW, they could look at a contract that the UAW had recently negotiated with Caterpillar, totally different industry. And by looking at the contract settlement highlights, they could see some of the things that the UAW was willing to entertain. A couple of examples include the elimination of the cost of living allowance formula. That was a key thing. Secondly, payment of lump sums in lieu of general wage increases. And thirdly, variable compensation in the form of quality awards. So it was not surprising to see that Detroit 3 automaker contracts negotiated with the UAW later in 2011 carried similar provisions to those negotiated months earlier in the Caterpillar UAW agreement. So looking at recent union settlements with the same union, it gives you some pretty valuable insight into what you might be able to negotiate in your contract. Another excellent tool is to prepare a bargaining environment assessment, which can be a simple side-by-side document that does an overall assessment of the current bargaining environment by comparing the current bargaining environment with the environment that existed during the last round of negotiations. Key elements to look at would include the following: macroeconomic factors that may indicate a measurement of the strength of the overall economy, such as inflation rates or unemployment rates. Industry factors that may identify strengths or challenges inherent in the industry, such as industry sales figures. Company-specific factors that may indicate either bargaining challenges or opportunities, such as company profitability or changes in demographics. These changes in demographics, if you have a new, younger workforce, they may be interested in wage increases, whereas if you have an older workforce, they may be more interested in things like pension. This next slide has a chart that illustrates employee or union versus company preferences. One of the guaranteed union demands in virtually every set of negotiations is a desire to improve and or protect the standard of living of its union members. Therefore, from the union's perspective, the most desired method of achieving this outcome is to demand base wage increases to improve the employee's standard of living, and in some cases demand some form of cost of living allowance to protect it. Base wage rate increases are generally preferred by the union due to their permanence and also due to their compounding effect over time. Conversely, companies generally prefer negotiated lump sum payments and variable compensation arrangements over base wage rate increases. These methods do not necessarily lock the company into fixed costs over time. In addition, variable compensation arrangements provide flexibility to the company, as the magnitude of the payments are typically tied to the achievement of specific goals such as profitability, quality, or attendance. In cases where variable compensation is linked to profitability, these payments are typically made when the company is most likely in a position to be able to afford them. Alternatively, in situations where variable compensation is linked to non-financial metrics, such as quality or attendance, the company would receive some form of benefit from improvements in these metrics. So in many cases, the value of these operating improvements may make these payments more or less self-funding in nature. Now we're going to start looking at some of the strategies associated with some of these different types of compensation. The first one we're going to take a look at is base wage rate increases. Companies should conduct competitive analysis on base wage rates, and this data can be used to manage expectations of employees and unions. Companies should always be prepared to present data to their employees or unions in order to make their case. Base wage rate increases may make sense in a number of situations. For example, base wage rate increases may be justified when your analysis of competitive wage rates indicates that your base wage rates are below market. There are a number of ways to research and to assess competitiveness of your base wage rates, including the following. As mentioned earlier, you can take a look at turnover rates. High employee turnover may suggest that your wage rates are too low. Conversely, low employee turnover rates may suggest that your wage rates are either reasonable or high. You can also informally benchmark local competitors, and you may have the opportunity to hire a consulting firm to conduct an independent survey. The other option, if available, you can analyze Bureau of Labor Statistics data in the United States or Statistics Canada data in Canada. Generally, increases in base wage rates are great for employees but are very expensive for employers due to the compounding effect of any increase plus the addition of fixed costs. Firstly, wage increases not only increase the cost of labor on a per-hour work basis, but also have a roll-up effect due to its application to all wage-related elements of labor costs. The roll-up effect has an impact on many wage-related elements, including overtime premiums, shift premiums, paid time off like vacations and holidays, income protection payments, certain life insurance and disability costs that are linked to wage rates, as well as legal costs such as Social Security and unemployment insurance. It's not uncommon for the roll-up effect to be 40% of the base wage rate increase. So in other words, a base wage increase of $1 per hour could cost a company $1.40 when analyzing labor costs on a per-hour work basis once you add in all these roll-up factors. Secondly, base wage rate increases have a compounding effect when provided in multiple years of the contract. For example, if a company provides a 2% base wage rate increase in every year of a 3-year contract, the 2% increase in the second year of the contract is calculated on the going-in wage rate plus the 2% increase that was provided in the first year of the contract. Same for the third year. It would include the cost of the first year and second year wage increases as well, so that compounding effect can be devastating. Base wage rate increases can also be used as a quid pro quo for operational improvements, and the amount of the operational improvement can assist in determining the magnitude of the base wage rate increase. So, for example, a $20 million improvement in operations may translate to a 2% wage increase, whereas a $30 million improvement may translate to a 3% wage increase. So there could be some linkage there. Another wage-related opportunity is where companies pay overtime premium only once an employee has over 40 compensated hours in any given week. This is an excellent strategy for employers who have a lot of overtime and have high absenteeism. It provides a deterrent to the employee who takes a Friday off and then wants to come and work on Saturday at time and a half to make up for it. Many times employees will take a day off during the week, Monday through Friday, only to work on Saturday to get the overtime premium and receive time and a half for that time period. Next area we're going to look at is cost of living allowance, or COLA, an area that is gradually becoming extinct. Unions typically look to a cost of living allowance formula to protect employees from inflation over the term of the contract, and COLA formulas are typically linked to changes in one or more consumer price indices over time. From a management perspective, COLA represents an automatic labor cost inflator, and if unlimited, can have a significant impact on long-term labor costs. The Detroit 3 automakers UAW contracts of the late 1990s had both base wage rate increases and COLA, leading to a spiraling labor cost increases. In contrast, the 2011 contracts eliminated COLA and provided lump sum payments to employees instead of traditional base wage rate increases, in recognition that labor costs must remain competitive. Cost of living allowances are typically folded into base wage rates at the expiration of the agreement, so COLA effectively has the same compounding and roll-up effect as a base wage rate increase over time. In the event that elimination of cost of living allowances is not a feasible option for the union, steps may be taken to mitigate these inflationary costs. One option is to establish a hurdle rate, where inflation must exceed a certain rate, for example 2%, before the COLA formula applies. This option may apply where employees will already receive base wage rate increases or lump sums. This formula would effectively top up the employees for excess inflation. Another option is to set a specific cap on inflation protection. For example, the COLA formula would be structured to protect employees for inflation up to 3%. In this case, employees would have to assume the risk for excess inflation. In most cases, COLA formulas have a specific replacement ratio. For example, the COLA formula may be structured to replace 80% of inflation. Another option would be to reduce this replacement ratio down to, say, 70% of inflation. Another alternative is where employees have generous healthcare benefit packages. Companies have successfully presented an argument that the company already protects employees for inflation relative healthcare costs, and therefore the consumer price index that excludes healthcare inflation should be the benchmark for inflation adjustments. I've seen examples of this in the past. And finally, I'd like to talk about COLA diversions. Unions will fight hard against taking existing wages and benefits away from employees. However, there are examples where unions are willing to consider COLA diversions, where a predetermined amount of future COLA payments will be diverted back to the company to help fund employee benefits. As an example, in 2005, General Motors was able to convince the UAW to divert 2 cents of COLA per quarter, worth approximately 3 cents per hour worked with roll-up, in order to help fund retiree health care. Unions are willing to consider COLA diversions as they represent future wage increases that are fairly transparent to the employee. So if the normal COLA calculation for a specific quarter would be a 10-cent increase with a 2-cent diversion, the employee would still enjoy an 8-cent per hour increase. I've seen cases where unions are willing to take that on. The next topic I'd like to discuss are lump sum payments. Lump sum payments are often a viable alternative to base wage rate increases, particularly when management can make the case that base wage rates are competitive. Lump sums allow the company to recognize solid employee performance without permanently adding to the overall labor cost structure. My labor relations professor astutely referred to lump sum payments as the raise that goes away. Unlike base wage increases, there is no compounding effect, and also there is no impact on your exit costs upon expiration of the agreement, since these lump sums are one-time payments. In the absence of a formal cost of living allowance formula, lump sums will be used to help moderate the effects of inflation over the term of the agreement, as evidenced by the inflation protection lump sums negotiated in the Ford UAW agreement in 2011. Again, there is no devastating compounding effect versus a traditional COLA formula. Lump sum payments can be structured either as a flat amount or as a percentage of eligible earnings. The advantage of structuring a payment as a percentage of eligible earnings is that the payout amount is automatically adjusted, where the intention is to differentiate and reward employees based on varying levels of wage rates. For example, a non-skilled employee versus a skilled employee, or to further compensate those individuals who have worked more overtime. Clearly, a fixed lump sum is easier to cost out than a performance bonus that's based upon eligible earnings. You have to be very careful in setting up your eligible earnings calculation, because it can get very costly very quickly if items such as overtime, holiday pay, vacation pay, etc. get loaded in as well. The last type of compensation that we're going to discuss is variable compensation. As indicated earlier, most employers prefer variable compensation as the desired approach to satisfy the union's demands for an increase in their members' standard of living. The advantage to the company is that these payments are contingent upon the achievement of certain predetermined goals or metrics. Accordingly, unlike an increase in the base wage rate, you do not necessarily add to the long-term fixed costs of a company. The magnitude of the payouts are usually predicated upon the degree of achievement of these goals. Therefore, the higher the achievement level, the higher the payout. Often the payout formula is based on a sliding scale, where payouts are not necessarily proportional, but rather increase exponentially as targets are either reached or exceeded. In addition, it is desirable to establish a threshold or minimum performance level that must be achieved prior to triggering any payout from the variable compensation formula. In addition, there are a number of attributes that should be taken into consideration, and we'll talk about them on the next slide. The following key attributes should be considered when designing a variable compensation structure. The first thing is eligibility criteria. Typical questions to address include the following. Are all employees eligible for the payment? For example, is it full-time only? Are part-time employees eligible for the payment? Should the payment be linked to individual employee contributions towards the results? And also, should the payout be prorated in any way or based upon an individual employee's hours worked? Are they controllable? Are the potential results seen as controllable by the employees? In most cases, there is more buy-in from employees if they feel that they have control over the outcomes utilized to measure the results. Are they measurable? Are the results easily measured? Are the metrics and targets clearly defined? Is the calculation itself simple and easy to understand? Also, will employees trust the calculation? Is there a need to have a third-party verification? And then also, are there relevant third-party metrics available? For example, in the automotive industry, should we look at J.D. Power initial quality study results to measure quality as an example? Are the variables attainable? Is it plausible that employees have a reasonable opportunity to achieve and or exceed targeted payouts during the term of the collective agreement? In this case, stretch targets may be acceptable by the union provided that there is a reasonable chance for a decent payout early on with an opportunity to grow that payout towards the maximum payout over the term of the agreement. And finally, timing. What is the proposed cadence and timing of the payment? Is it monthly, quarterly, or is it an annual payout? And the timing of the payouts in itself can be strategic. For example, for morale purposes, many companies now target their bonus payouts on or around popular shopping holidays such as Memorial Day and Black Friday in the United States. Where practical, it's preferable to negotiate the metrics and targets relative to variable compensation one time, and that is during the collective bargaining process. Unions often want to renegotiate the targets during the course of the agreement. I've been involved in cases where the agreement is that management will set the variable compensation targets on an annual basis, and in these cases, the targets are not up for negotiation. However, management does review the targets with the union each year. That's probably one of the best ways to go. Where practical, it's preferable to negotiate the metrics and targets relative to variable compensation one time, and that is during the collective bargaining process. In certain cases, these targets are not up for negotiation. However, management should review the targets with the union each year. There are essentially two main types of variable compensation, those based on financial metrics and those based on non-financial metrics. Both concepts we'll discuss next. First, we'll talk about variable compensation based upon financial metrics. Profit sharing is an excellent example of variable compensation that is linked to financial metrics. The main advantage of profit sharing to the company is that the magnitude of the payouts are directly linked to the profitability of the company. Accordingly, higher payouts are made when the company can afford it, and lower or no payouts are made when the company is less profitable or in financial distress. During 2011 national bargaining, the United Auto Workers Union made it clear to the Detroit 3 automakers that they wanted to change the profit-sharing formula that had been in place for over a decade. At the time, the profit-sharing formula was extremely complex, and the union wanted more transparency into the calculation for their members. The profit-sharing calculation included numerous adjustments for items such as executive bonuses and restructuring costs. Therefore, the profit-sharing calculation was more or less performed after the books were closed for the year, and UAW members really had no clue what their profit-sharing checks were going to be until the first quarter of the subsequent year. General Motors was the target company for UAW bargaining with Detroit 3 automakers that year. In response to the UAW's desire to modify the profit-sharing formula, the team at General Motors did an excellent job redesigning the variable compensation model in order to address the union's concerns. The formula was simple. Provided that profits exceeded a minimum dollar threshold, eligible employees were to receive $1 for every $1 million in General Motors North America profit. From the UAW's perspective, this redesign ticked all of their boxes as follows. 1. It was simple. 2. The calculation was easily verified as the North America profit figures were already audited by the company's external auditors. And 3. It was transparent to the UAW members. Each quarter, the employees could look at the publicly filed financial statements of General Motors. Accordingly, UAW members could perform a quick analysis each quarter by themselves. If General Motors North America year-to-date profits for the third quarter were $6 billion, then their profit sharing earned to date would be $6,000. It was as simple as that. This is a great example that illustrates that it is quite possible for the union and management to work together to design a profit sharing structure that is suitable for both sides. Next, we'll talk about variable compensation tied to non-financial metrics. Many times, variable compensation is linked to non-financial metrics, and there's an opportunity to create a win-win situation for both the union and management. From the union's perspective, it's an opportunity to improve the standard of living of its members in the form of a lump sum payment. On the other hand, from the company's perspective, it's an opportunity to improve one or several operating metrics, in which case the lump sum payment to employees may be somewhat self-funding. In addition, these proposed lump sums may take the pressure off union demands for higher general wage rate increases. There's really no limit as to what types of non-financial metrics may be included in these types of compensation strategies. Some of the more common metrics are as follows: productivity, quality, safety, attendance, and customer service. It's not unusual for multiple key performance indicators, including both financial and non-financial metrics, to be included in one composite variable compensation structure. Accordingly, appropriate weightings would be applied to each element. In addition, companies and unions often negotiate gain-sharing arrangements. There is one note of caution I'm aware of with respect to the payment of certain bonuses as they relate to the calculation of overtime pay in some jurisdictions. For example, in the United States, for purposes of calculating overtime pay, the Fair Labor Standards Act, or FLSA, provides that non-discretionary bonuses must be included in the regular rate of pay. Therefore, where an employee receives a specific type of non-discretionary bonus of, say, $4,000, assuming 2,000 hours worked per year, the employer may be required to add approximately $2 per hour, which would be the $4,000 bonus divided by 2,000 hours work, to the employee's regular rate of pay for purposes of calculating overtime pay. Non-discretionary bonuses subject to these rules may include those, in quotes, that are announced to employees to encourage them to work more steadily, rapidly, or efficiently, end quote. Clearly, employers should research the Fair Labor Standards Act in order to fully understand the implications of any bonuses prior to making any offers to the union. So this is the end of the compensation section. I'll just do a quick summary here. Again, researching competitive analysis is key. Make sure you tell the story to the employees. Share your data points with them. Try to get them to understand, why their wage rates are already competitive, or perhaps why you're looking for implementing a variable comp structure rather than base wage rate increases if you're in a union negotiations. Also, brainstorm ideas with the union and try to seek win-win situations that similar to what we've described here earlier. And don't be afraid to ask for the union's ideas. They often have some excellent ones. Variable comp and lump sums are generally better for employers, again, because of the affordability aspect. If companies are doing well, they can afford to pay. If they're not doing well, then they're not saddled with the fixed cost aspect of base wage increases. Also, there's the whole self-funding aspect. If you have lump sum payments that are linked to metrics, operational metrics, and so on. And peer pressure can be an amazing thing, especially if you have some awards that are kind of linked to group performance for, say, attendance or quality. Peer pressure can be an amazing thing. And also, future new hires may be your best opportunity. And we'll talk a little bit about more of that in the next section on workforce composition. If you're looking at changing wage rates over time, your future new hires is probably your best bet in terms of doing that. And just to finally, be creative. There are all kinds of opportunities to make changes to comp structures, and you can be as creative as you want. The second half of this module deals with workforce composition. As an introduction, one of the greatest opportunities to mitigate overall labor costs over time is through the modification of a company's workforce composition. So in general terms, the company changes its workforce structure by introducing some proportion of lower cost employees in order to drive down the overall weighted average or composite all-in labor costs of the company. While this approach does not change a company's overall labor costs overnight, the labor cost structure does improve over time as new employees are added either to backfill attrition or to staff expansion of the company's workforce. If you're adding a new shift at the same time as you're changing your workforce composition, that change in overall labor costs can occur very quickly. There are some significant advantages to this approach. Provided that existing employees are red-circled or grandfathered from a wage and benefit perspective, there is usually minimal resistance from them or their unions, and any union resistance is typically principle-based. So some unions may be just principle-based against things like two-tier wage structures and things of that nature. Future new hires do not vote on the contract, so this fact helps with ratification, and unions are able to rationalize utilization of lower paid employees in certain circumstances that we'll touch on a bit later. Lower paid job classifications can be designed through modifications to either wages and or benefits. And in many cases, cost savings can be significant, as we'll see later. One of the best ways to understand the cost savings associated with the change in workforce composition is to look at an illustrative example. So that's what we have on this page. On the left-hand side in red, you'll see the current state, which is basically a one-tier structure. So in this case, you have one classification, 100% of the workforce, and in this case, the all-in hourly labor cost is $40 per hour, which is obviously the same as the weighted average labor cost, $40 per hour. Then if you look at the future state, we've got two different models we're looking at. The top one is the future state with the two-tier structure, and the second one is the future state with the three-tier structure. So with the two-tier structure, you have two classifications, and you're assuming that the first classification under the two-tier structure, 80% of your employees are at $40 all in per hour, and the weighted average labor cost would be $32. So 80% times $40 is $32. And then if you introduce a second classification, and over time, if that second classification can grow to be 20% of your workforce, and the all-in labor cost for that group of employees is $25 per hour, perhaps they're temp employees, perhaps they're two-tier employees, but their labor costs are $15 an hour lower than the traditional employees at $40. So in this case, 20% at $25 gives you $5 towards your composite. So as you can see in this case, your composite labor cost goes from $40 under the current state down to $37 in the future state with the two-tier structure. So there are significant potential long-term savings. So if we assume here that you have 1,000 employees working 2,000 hours per year, it's equal to 2 million hours per year. So if you look at the potential annual savings, it's $6 million per year, because you've got your current state at $40 per hour, and over time, with the two-tier structure, your composite's going to go down to $37 per hour. So the $3 differential times 2 million hours worked per year gives you $6 million in savings. And it's really the same drill for the future state with the three-tier structure. In this case, you're just adding another tier where the third classification is at $20 per hour, and your percent of workforce is 70% tier 1, 20% tier 2, and then 10% at this third classification. So you can see your composite is down to $35. So in this situation, you have a $5 differential versus your $40 current state. So $5 differential times 2 million hours, you're looking at savings of $10 million a year. So it doesn't happen overnight unless you're adding a significant number of employees, maybe a shift addition or something like that. But over time, as you have attrition and so on, these savings can be significant. And also for strategic planning purposes, a quick calculator of labor cost savings can be created by looking at the differential between the existing labor cost rate, so under the current state $40, and the proposed labor cost rate of that second tier at $25. So all you do is you take the differential of $15 per hour, the 40 versus the 25, and simply multiply by 1% in order to generate a labor cost savings calculator of 15 cents per 1% migration to the lower rate. So the second tier example, 15 cents per hour times 20% of your staff is $3 per hour in savings on your composite, which is consistent with the $37 that we're showing up in the chart. These simple calculators often prove to be very helpful when negotiating with the union under tight time constraints. While the potential savings related to a change in workforce composition appear impressive, there are a couple of notes of caution here. Firstly, this approach is typically a long-term versus short-term solution, since unions would normally only allow this type of workforce migration to occur prospectively. That is, it affects future new hires while current employees are grandfathered into the existing wage and benefit structure. Accordingly, in this case, workforce migration would typically occur prospectively one of two ways. New hires backfill normal attrition of current employees, for example, terminations or quits, deaths or retirements, etc., or new hiring requirements as a result of business expansion. So in many of these situations, companies will often perform cost-benefit analyses with respect to offering retirement incentives to long-service employees in order to encourage them to retire and speed up the migration to a lower composite all-in labor cost. In the example above, assuming a typical employee works 2,000 hours per year and there's a labor cost differential of $15 per hour in the two-tier situation, that would be the $25 per hour versus the $40 per hour, the company could offer a long-service employee a lump sum retirement incentive of $30,000. resulting in a 1-year payback period. In essence, the long-service employee with an hourly all-in rate of $40 per hour would retire and be backfilled with a new hire carrying in an all-in labor cost of $25 per hour. Earlier on, I alluded to the fact that changes in workforce composition is one of the most union-friendly opportunities to reduce overall labor costs. This slide kind of deals with that. While there's never a guarantee the union will accept modification to a company's workforce structure, the following scenarios and/or conditions typically increase the likelihood of that acceptance. 1. Current employees are demanding significant contract improvements, and the company requires offsets to fund these demands. 2. The company is insisting on contract concessions from current employees due to legitimate competitiveness or solvency concerns. 3. The company is leveraging opportunities for new work, expansion of the workforce, or investment commitments in some sort of job security. 4. New lower paid classifications such as temporary workers or dues-paying union members. 5. New lower paid employees have the ability to bid on higher paid jobs when they become available, assuming that they have the appropriate skill set to do so. And 6. Current employees are grandfathered into their existing wage and benefit structure. In that case, they are more willing to ratify these agreements. Next, we're going to look at alternatives to change workforce composition. There are numerous ways to reduce overall labor costs through changes to the workforce composition and/or structure. A few of the more common methodologies are highlighted as follows, and in turn, we'll take a look at them. 1 is to modify the company's wage progression model. 2, utilization of temporary employees, whether they be part-time temps or full-time temps. 3 is creation of a 2-tier or multi-tier systems. And 4 is to have a permanent reset of the workforce. The first workforce composition model we're going to look at is wage progression. Modification of the company's wage progression model is one of the simplest ways to reduce overall labor costs over time. The wage progression period is essentially the time that it takes for an employee to progress from the starting base wage rate to the maximum base wage rate. By extending the wage progression period, it allows the company to utilize employees at wage rates that are less than maximum rates for a longer period of time. It's not unusual these days to see wage progression periods as long as 8 to 10 years. This chart provides an illustration of potential wage savings related to a single employee over time when the wage progression period is increased from a 4-year period to an 8-year period. In this example, the employer could save over $33,000 per employee over an 8-year time horizon. And these savings do not include the roll-up effect on wages that we discussed earlier for things like overtime, etc. The roll-up effect on wages could potentially add another 30 or 40% to savings. As you can see in the chart, year 1, employees start off at $16 per hour. And in the first alternative 1 at the top, you can see that at the beginning of year 5, they achieved maximum wage rate of $24 at that time. But in alternative 2 down below, with an 8-year wage progression, the employee doesn't achieve $24 an hour until the beginning of year 9. So if you look at the cumulative wages paid to the end of year 8, under alternative 1 with the 4-year wage progression period, the total is around $357,000. And under alternative 2, under an 8-year wage progression period, the total paid is around $324,000. So as you can see, you have cumulative savings of around $33,000 per employee. The overall savings then can be significant if the company is adding hundreds of employees. Accordingly, companies should definitely consider approaching the union with a request to increase wage progression periods when they're leveraging potential new investments and/or volume increases that require significant increases in manpower. The key advantage of wage progression modifications versus other workforce composition models is that it does not create a permanent differential in wages versus high seniority employees. In addition, one can rationalize a grow-in period to full wages, assuming that in many cases it takes employees years to learn multiple jobs and to be able to contribute value-added kaizans and employee suggestions, etc. The next workforce composition opportunity we're going to discuss is utilization of temporary employees. The ability for companies to utilize temporary employees is extremely valuable in many situations. While it generally assists the company in lowering its overall labor cost structure, we'll also see that it can provide flexibility when dealing with situations of uncertainty such as absenteeism or temporary spikes in demand for the company's products or services. The all-in labor cost of a temporary employee is often 1/2 to 2/3 of the cost of a traditional employee, creating significant labor cost savings opportunities. The cost of temporary employees is typically lower for the following reasons. They have a lower base wage rate, typically at the starting wage rate of a traditional employee, if not lower. If a temporary employee is working part-time on weekends, in many cases overtime premiums may be saved versus a traditional employee. Also, temporary employees typically receive minimal, if any, fringe benefits. Any healthcare benefits offered are usually quite basic and will likely not include coverage for things like prescription drugs, dental, or vision coverage. In situations where the company hires the sons or daughters of employees as temporary employees, they are often already covered under the employee's benefits, though there are minimal or no incremental costs. In this case, you're almost giving the sleeves out of your vest. Also, temporary employees typically do not have any income protection in the event of a layoff or job loss. In general, temporary employees can be considered either part-time, where they normally work less than 40 hours a week, or full-time, where they typically work at traditional week of 40 hours or more, get part-time employees, or employees who typically work less than 40 hours per week. Unions have accepted the concept of utilizing part-time and temporary employees in a variety of situations. The most common example is where part-time employees are hired on or around weekends to cover for high rates of absenteeism during this time frame, or to cover for full-time employees who simply may not be interested in working overtime on the weekend. These arrangements are quite common in the automotive industry, where these employees are often affectionately known as weekend warriors, as they are typically able to work on weekends as well as Fridays and Mondays, times when there's usually excessive absenteeism. Many of these employees are on call during these days and are called in to cover both excused and unexcused absenteeism. In addition, in some cases, the union may allow these part-time employees to work on traditionally higher absenteeism days, such as the day after St. Patrick's Day or the day after the Super Bowl. Full-time temporary employees, on the other hand, are more similar in nature to traditional employees. They are not on call, but rather work basically the same full schedule as a traditional employee, without, however, the same level of wages and benefits. Again, as I am most familiar with the automotive industry, here are a few scenarios that illustrate utilization of full-time temporary industries in this industry. First one is summer vacation replacements. Full-time traditional employees normally utilize a disproportionate amount of their vacation entitlement during the summer months, perhaps to enjoy the nicer weather or to spend time with their children while they're on summer school break. Therefore, many union contracts allow for utilization of full-time temporary employees during the months of May through September. Individual employees are normally allowed to work up to either 90 or 120 days during this time frame. Another example is during peak demand scenarios. There are times in the automotive industry when automakers either perform a major redesign in an existing product or introduce a totally new vehicle that is a home run with consumers. In these situations, it's not uncommon for the companies to add a temporary shift of production in order to meet high initial demand for these vehicles. Since there is uncertainty with respect to the duration of this peak demand, the companies and unions will often negotiate the utilization of a temporary full-time workforce rather than committing initially to a permanent workforce that may be placed on layoff within a year. In most cases, the parties will have a common understanding that if, for example, after a year the demand for this vehicle is still high, that the parties will get together to discuss whether or not these temporary employees should be converted to full-time traditional employees. The third example pertains to full-time temporary employees utilized for unplanned absenteeism. Generally, absenteeism is covered off by hiring temporary employees such as weekend warriors and summer vacation replacements, as discussed earlier. However, due to excessive overtime scheduling or other reasons, unplanned absenteeism has become a significant challenge for the Detroit 3 automakers in the United States during recent years. As you can imagine, it is extremely difficult to start up an integrated assembly line that requires 1,000 or more employees if many of those employees are unexpectedly absent. Unplanned absenteeism relates to instances such as casual or unexcused absences, unplanned sickness and accident absences, as well as intermittent Family Medical Leave Act or FMLA absences. In response to this concern, one of the solutions developed during 2015 negotiations with the United Auto Workers Union was to allow the automakers to carry lower cost full-time temporary workers up to a certain limit at each plant. The limit is effectively calculated based upon individual plant experience relative to unplanned absenteeism metrics. So, in summary, temporary employees providing the company with an excellent opportunity to lower overall labor costs while mitigating the effects of absenteeism and uncertainty. In addition, temporary employees provide an excellent feeder pool for future permanent employment needs. The company will have had the opportunity to directly assess the employee with respect to key attributes such as attendance, as well as attention to things like safety and quality. Third place is unplanned absenteeism. The next workforce composition strategy opportunities that we're going to discuss are two-tier and multi-tier structures. The creation of two-tier or multi-tier wage and benefit structures provide a more permanent solution to mitigating overall labor costs. As indicated previously, this type of approach to overall labor cost reduction is normally more appealing to existing employees, provided that they are in effect grandfathered in to their prevailing wage and benefit package. Future new hires do not exist yet, so they do not vote on the contract. Accordingly, ratification is less of a challenge. However, companies should expect that there will be some stalwart union supporters who will lobby against ratification purely based on principle. If unions are supportive of this concept, companies should do everything in their power to make sweeping changes to the overall wage and benefit package for future new hires. This should be seen as a once-in-a-lifetime opportunity to reset both the wage and benefit components of labor costs. It is a chance to implement fundamental changes that, in most cases, have been resisted by the union and its current membership for years. Over the past decade or so, many companies, including those in the automotive industry, have created new tiers of employees. Many of these companies have been very successful in making fundamental changes to the wage and benefit structure of new hires. Examples of these fundamental modifications are as follows. First, wage-related changes. We've seen reductions in the maximum base wage rates versus traditional employees. We've seen elimination of or deferral of eligibility for cost of living allowances or COLA. We've also seen the conversion of shift premiums from a percentage of base wage to a flat dollar amount. For example, afternoon shift premium, changing it from a 5% of base wage to a flat $1 per hour. Also, midnight shift premium, changing from 10% of base wage to a flat $2 per hour, changes such as that. We've also seen a lot of benefit-related changes. We've seen a reduction in overall benefit entitlements, conversion of plan designs for pensions and retiree health care coverage from defined benefit to defined contribution models. Those are things that the unions have been resisting for years. Longer grow-in periods for eligibility related to health care benefits such as dental and vision coverage. Maybe the grow-in period is 3 years or 5 years in some of those cases. We've also seen higher cost share amounts for health care. And finally, a reduction of or elimination of job security benefits such as supplemental unemployment benefits or SUB. As you can see, any combination of the above noted modifications to the wage and benefit structure of new hires can have a profound impact on the overall labor costs of the company. So as you can see, labor cost savings can be significant by going to this type of a model, but they do not happen overnight. So in some cases, it may make sense to offer retirement incentives in order to accelerate some of the abnormal attrition. Next, we're going to talk about two-tier structures. Two-tier structures are likely the most common approach utilized to reduce overall labor costs. Existing or traditional employees maintain their prevailing wages and benefits, while any new hires are covered under the new lower cost Tier 2 wage and benefit structure. There are two common options with the two-tier system. There is either a cap on the number of new hires or there is no cap. So first, let's look at the cap approach. The cap approach allows the company to hire future employees or new hires up to a certain level or proportion of the workforce. Once the cap is reached and an attritional opening occurs in the traditional workforce, the most senior new hire would flip or effectively graduate to the traditional employee wage rate. In most cases, the new hires would carry their benefit entitlements with them, particularly for defined contribution type benefits related to pensions and retiree health care coverage. This senior new hire would then be backfilled with a new hire in the two-tier wage and benefit structure. During 2000 negotiations with United Auto Workers, the Detroit 3 automakers were able to negotiate a two-tier wage and benefit structure with a 25% cap. At the time, the industry was in the midst of a downturn, and the maximum base wage rate for traditional non-skilled employees was maintained at approximately $28 per hour. These traditional employees also retained their defined benefit pension plan, and retiree health care coverage was to be provided by the new UAW Healthcare Trust. In contrast, under the new contract, future new hires would have a maximum base wage rate of approximately $19 per hour and would have a defined contribution pension plan along with a company contribution of $1 per compensated hour in lieu of retiree health care. So effectively, the old defined benefit for health care and pensions was more or less gone for these new hires. In theory, once the 25% cap was exceeded, the most senior UAW new hire would effectively graduate, and his or her base wage rate would increase to the higher traditional employee rate of pay of approximately 28 hours per hour at that time. However, in this case, the employee would continue to receive defined contribution amounts for both pensions and retiree health care. The advantage of this approach to the company is that the company will enjoy lower labor costs for up to 25% of its workforce, thus reducing the composite labor cost of the company over time, as illustrated earlier in the example that we showed. In addition, since new hires carry their defined contribution benefits for pensions and retiree health care with them for their entire career, over time the company is able to de-risk its balance sheet by reducing defined benefit liabilities for things like pensions and retiree health care. The disadvantage of this approach to the company is that a cap model like this does not create a full reset of the workforce like the no cap model that we'll discuss later. From a union perspective, the key advantage of this approach is that existing or traditional employees maintain their wages and benefits, relieving some of the ratification challenges, since the changes effectively don't impact them at all. On the other hand, with respect to new hires, the union should be able to rationalize that these new members can ultimately achieve the traditional wage rate once it is their turn to graduate. That is, once that 25% cap has been exceeded and it's their turn to graduate. In addition, through benchmarking, the union should be able to demonstrate that defined benefit pensions and retiree health care coverage are more or less a thing of the past. There are a couple of disadvantages that should be noted, however. Firstly, the union cannot guarantee when a new hire will graduate to the higher level of wages. The timing is largely dependent upon the attrition rate of traditional employees, as well as the timing and nature of any future workforce fluctuations, whether they are increases or decreases. Secondly, new hires often become frustrated that they may be working side by side doing the same job as a traditional employee while earning significantly less. This may cause some issues. Alternatively, the no-cap approach allows a company to effectively permanently reset the labor costs of its workforce over time. Eventually, through the attrition of traditional employees, 100% of the workforce will be covered by the new hire wage and benefit structure, since without a cap, everyone hired goes straight to the new Tier 2 model. From a labor cost perspective, it may be the preferred approach for the company, but it carries even more challenges with the workforce in terms of morale for both the company and the union. Without a formal cap, employees do not automatically graduate to a higher traditional level base wage rate once it is their turn. They can only hope to reach that level of earnings one day, and some may believe that they will never attain that standard of living. This creates even more animosity in a two-tier workforce where you basically have the haves and the have-nots working side by side. As the new hire population grows in size, competing interests between new hires and traditional employees begin to develop during bargaining. New hires may be more interested in increasing base wages, while traditional employees may be more focused on pension improvements. These competing interests create difficulties for both the union and management during bargaining, as the parties attempt to craft an agreement that will satisfy varying interests in order to facilitate ratification. Development of a sound bargaining strategy becomes extremely important in these types of scenarios, and it's extremely important to analyze your workforce demographics utilizing age and service grids so you can see where the largest populations are. So in summary, for two-tier systems, the union's concerns are really, it's a violation of their equal pay for there can be a lot of animosity where employees are working side by side and they're making different amounts. Under the cap approach, there's less of an issue since at some point employees will graduate to the higher wage rates once that cap has been exceeded and it's their turn to graduate. It's really the no cap approach where it's a permanent reset of the labor costs of your workforce is more of an issue for the union. The next option we're going to discuss are multi-tier structures. Multi-tier structures offer a potential solution to the shortcomings of the cap approaches that we just discussed. In simple terms, multi-tier approaches create an equal pay for equal work environment where employees working side by side performing similar work are paid the same. In theory, with multi-tier structures, one would expect that unions would receive fewer complaints from employees since their peers, as defined in this structure, are paid the same. If structured properly, all employees should be able to see a clear path to the highest wage at some point in their career, assuming that employees are able to utilize seniority provisions to bid on higher paying jobs. In practice, for this to work, low seniority jobs would attract lower rates of pay, and conversely, higher seniority jobs in the plant would attract higher rates of pay. In addition, companies would be able to enjoy the same downward pressure on labor costs as noted in the two-tiered structure. Where a company currently has a one-tier structure, it will take some time to disaggregate the workforce into logical tiers. Then the challenge is to convince the union that the tiers are appropriate and then negotiate starting and maximum base wage rates for each tier. The union will undoubtedly insist that existing employees are red-circled or grandfathered into their current wage structure, so the migration to a lower cost model will likely take some time. The best way to illustrate the multi-tier approach is to look at hypothetical examples. Let's look at an example of a non-skilled workforce in the manufacturing industry. Let's also assume that in the manufacturing plant, there are both assembly and sub-assembly operations, and for the most part, the higher seniority employees migrate to the assembly operations. And also assume that all employees are paid $25 per hour, regardless of whether or not you're in assembly or the sub-assembly operations. So in order for this concept to work, equal pay for equal work, you would have to disaggregate the classifications of the existing workforce and create new subclassifications with different pay scales. So perhaps in this case, the assembly operations would have $25 per hour maximum base wage rate, and the sub-assembly operations would have a maximum base wage rate of $20 per hour. So over time, assuming that there was like 80% of your was assembly and 20% was sub-assembly, you would drive down that composite labor cost over time. So everyone would be grandfathered in at this point in time, but anyone new coming into the company would go into the $20 per hour sub-assembly jobs, and then they would be at that rate of pay until they had the sufficient seniority to bid on an assembly job at $25 per hour. So in this case, you would have equal pay for equal work. Anyone doing assembly jobs would make $25 per hour. Anyone doing sub-assembly jobs would make $20 per hour. And the existing employees would obviously be grandfathered in. Another example is to take a look at the skilled trades workforce in the manufacturing industry again. In this case, there may be an opportunity to create a newer, lower paid semi-skilled classification that may just focus on routine machine maintenance, for example, greasing and oiling of machines. This would allow the higher paid skilled trades employees to focus on machinery repairs. So perhaps the higher paid skilled trade employee would make $40 an hour, while the semi-skilled classification would make $30 per hour. This is another way to drive down your labor costs, and you would still be applying the equal pay for equal work concept. Conversion from a one-tier to a multi-tier approach like this is not going to be easy, but the equal pay for equal work approach appears to be more palatable for the union versus the two-tier structures with the cap and no cap models that we discussed earlier. So in summary, for the workforce composition section of this module, changes in workforce composition can deliver significant labor cost savings over time. And we've also seen that there are multiple levers available to achieve your goals. Anything from changing your wage progression periods to utilizing temporary employees, two-tier systems, multi-tier systems. There are many, many opportunities. Acceleration of the migration to a more favorable labor cost structure is possible if you're expanding your workforce. And secondly, you can also offer retirement buyout offers to accelerate normal attrition. And also, union acceptance is quite possible under certain conditions. Unfavorable economic environments, provided you grandfather existing employees, there's a better chance of ratification that way. And the equal pay for equal work model that we talked previously about with a multi-tier structure has a better chance of ratification than the two-tier model. Strategy may enable employees to obtain concessions from future employees that they've been trying to obtain from current employees for decades. So, thank you. Thank you for taking the time to participate in our on-demand webinar today. I am pleased to inform you that HR and Labor Guru has 3 distinct on-demand webinar series with a total of 7 modules as follows. First, we have the Reduce Your Labor Cost series, and there are 2 modules in this series. Secondly, we have the Bargaining Preparation series, and again, there are 2 modules in this series. And finally, we have the HR Analytics series, and there are 3 modules in this particular series. I would like to take a few minutes to talk to you about the content in the respective series. In a few instances, certain strategic concepts are introduced at a high level in one module, and then for those of you who are interested, presented in a deeper dive format in another module. I will attempt to highlight these situations as I quickly walk you through the module highlights. First, let's talk about the Reduce Your Labor Costs series. These modules will appeal to anyone interested in reducing their labor costs, whether you're an HR or labor professional looking to redesign your compensation and benefit plans, preparing for negotiations with the union, or simply a corporate controller looking for opportunities to reduce labor costs. Part 1 of the Reduce Your Labor Costs series deals with compensation and workforce composition. In this series, you'll develop an in-depth understanding of the numerous financial elements that should be considered when calculating all-in labor costs. Also, you get an understanding of several internal and external factors to take into consideration when contemplating modifications to compensation. Also, compare and contrast employee or union versus company preferences with respect to compensation alternatives, to recognize strategic opportunities to offer lump sums and/or variable compensation versus fixed wage increases. And finally, in this module, you'll obtain a clear understanding of how changes to a company's workforce composition can be one of the most union-friendly opportunities to significantly reduce and/or mitigate rising all-in labor costs over time. In contrast, Part 2 of the Reduce Your Labor Costs series deals primarily with healthcare, pensions, and other employee benefits. In this module, you'll gain an appreciation for the importance of plan design decisions in driving overall employee healthcare costs. You look at things like employee cost share, delivery models, and clinical programs. Also, you look at the identification of the multiple levers, strategies, and tools available to mitigate rising healthcare costs. Also, we'll take a look at a 3-step analytical approach to identify key focus areas in order to facilitate potential cost reduction strategies for healthcare. And also, we'll have a comprehensive strategy to address high-cost healthcare elements using a reduce model. And we'll also take a look at developing win-win healthcare solutions for both employers and employees or their unions. In addition, you'll understand cost mitigation strategies for other employee benefits, including pensions, disability, life insurance, paid time off, and retiree benefits. And finally, learn about proven strategies aimed at reducing other post-employment benefit obligations and costs related to retiree benefits. Secondly, let's talk about the Bargaining Preparation and Strategy Formulation series. These modules will appeal to anyone looking for practical guidance relative to preparing for bargaining with the union, whether you're a member of the actual negotiations team or a member of one of the support teams, such as finance or public relations. Most of the content, particularly with respect to strategy formulation, will appeal to all levels of an organization, including directors and vice presidents. Part 1 of this series is called Bargaining Preparation. This module outlines the key negotiations preparation activities that should be performed from 12 to 18 months in advance of bargaining right through to opening day. The key areas of focus for bargainers typically include the following: a bargaining environment assessment, development of a robust internal governance process, development of negotiations costing models, formulation of bargaining strategy, and finally, creation of a comprehensive communication strategy. And all of these elements are dealt with in this module. While negotiations, costing models, and strategy formulation are presented at a high level in Part 1, for those of you interested in more of a deep dive, I would highly recommend looking at Part 2 in this series as well. Part 2 is called Negotiations, Costing Models, and Strategy Formulation. In this module, you'll develop an in-depth understanding of the numerous financial elements that should be considered when calculating all-in labor costs and creating negotiations costing models. You'll also obtain a clear understanding of how to develop a dynamic cost model by utilizing a simple 3-step approach. In addition, you'll learn how to develop practical bargaining tools that can be utilized to improve efficiencies when costing out union demands and management proposals, develop alternative economic offers, and assist in formulating overall bargaining strategy. As well, you'll learn how to develop a simple matrix that will assist the company in identifying potential win-win solutions with the union. And finally, you'll understand the importance of developing a comprehensive economic offer playbook by consolidating input from the various subcommittees. And finally, let's talk about the HR Analytics series. These modules will appeal to a wide variety of professionals, including those in the analytics, finance, HR, and labor relations fields. Part 1 of this series is entitled Building a Value-Added HR Analytics Function. In this module, you'll take a look at the structure, roles, and responsibilities of an effective HR analytics team. We'll also talk about how to address common challenges that companies face in growing their HR analytics function. We'll identify quick wins and value-added projects that will appeal to both HR business partners and HR centers of excellence. And finally, we'll take a look at an introduction to predictive analytics through an illustration of a 6-step process. Part 2 of the HR Analytics series is called Breaking the HR Analytics Paradigm. We're going to be looking at hourly workforce data. First thing we're going to look at is recognizing the low-hanging fruit associated with the examination of hourly workforce data. We're going to focus on operational and cost savings opportunities associated with 3 distinct areas. First, absenteeism, including Family Medical Leave Act in the United States. Secondly, the hourly hiring process. And thirdly, hourly employee payroll data. And the final module in this series is Part 3 that deals with healthcare analytics. We're going to gain an appreciation for the importance of plan design decisions in driving overall employer healthcare costs, look at things such as employee cost share, delivery models, and clinical programs. In addition, we're going to look at the identification of multiple levers, strategies, and tools available to mitigate rising healthcare costs, and also have to do an in-depth understanding of a 3-step analytical approach to identify key focus areas in order to facilitate potential cost reduction strategies. And we'll also look at a comprehensive strategy to address high-cost elements utilizing the reduce model. And the idea here is to develop win-win solutions for both employers and employees and their unions. Thank you for your time. I hope that these webinars provide you with valuable guidance and practical solutions in addressing the many HR and labor challenges facing your organization.